As artificial intelligence models scale up, the massive server clusters powering them are running into a hard physical limit. Traditional copper interconnect cables simply cannot carry enough data fast enough to keep up with the newest GPUs. To stop the network from choking on its own data centers have to replace that copper with fiber optics. They need high-speed transceivers that translate electrical signals into light, pushing massive amounts of information across the facility in microseconds. The money flowing into this hardware swap is immense. Industry projections show the market for AI optical interconnects expanding from roughly $3.75 billion today toward $18 billion by 2033. Applied Optoelectronics, or AAOI, caught this wave at exactly the right time. Just a couple of years ago, the company was trading near $2 a share and fighting to survive. Now, it operates as one of the purest public plays on the AI optics bottleneck. This chart illustrates the market's reaction. We see the broader AI optics growth curve. Overlaid is AAOI stock price, spiking from $2 to around $200 a share. This retail enthusiasm pushed its valuation to roughly 207 times forward earnings. Professional analysts are looking at those exact same numbers and drawing a very different conclusion. While the market trades the stock above $185, the average Wall Street price target sits closer to $80. Recognizing a massive infrastructure build-out is relatively easy. The harder task is deciding if the company attached to it can actually convert that demand into sustainable profits, or if you are buying into a fragile momentum trap. AAOI holds a distinct structural advantage in how it builds its hardware. Instead of buying all its components from outside suppliers, it is vertically integrated, fabricating its own semiconductor laser chips directly in-house. Right now, those specific lasers are one of the most heavily constrained bottlenecks in the entire AI supply chain. Because AAOI makes its own, it secures a level of supply certainty that many of its competitors lack. They also build these components domestically. This aligns perfectly with federal and state efforts to secure the U.S. semiconductor supply chain, a strategy validated by the roughly $21 million Texas Semiconductor Innovation Fund grant they recently secured to expand their local footprint. But scaling up domestic manufacturing facilities from scratch requires an enormous amount of upfront capital. Even though AAOI has posted 5 consecutive quarters of record revenue, the business continues to operate at a net loss. Their gross margins currently hover around 29%, which falls significantly short of their own 40% target. This scorecard reveals the cost of that expansion. To keep the lights on and build capacity, management had to raise capital by issuing new stock. This heavily diluted existing investors, ballooning the total share count from roughly 39 million up toward the 70 million range. Their revenue is also heavily concentrated among a tiny group of hyperscale buyers. A massive $200+ million order from an Amazon subsidiary is currently doing the heavy lifting for their forward projections. Relying on a single tech giant carries immense risk. Back in 2017, Amazon abruptly shifted its procurement strategy, an event that devastated AAOI's stock price and nearly wiped out the company. When a company carries a valuation in the $14 to $16 billion range while still losing money, the market is pricing in years of flawless execution. If a single hyperscaler delays an order, or if their next-generation tech falls behind schedule, the downside could be severe. You do not have to take on that level of concentrated, single-company risk to capture the upside of the data center build-out. Look at a company like Coherent. They are the volume leader in this space, holding roughly a 25% market share in optical transceivers. They generate nearly $6 billion in annual revenue, they are solidly profitable, and they have secured a direct $2 billion strategic investment from NVIDIA to build out capacity. Then there is Lumentum, which operates as a critical upstream supplier for the entire ecosystem. Lumentum manufactures the exact high-end laser chips that nearly every other transceiver manufacturer desperately needs. They control an estimated 50 to 60% of this market, turning them into a massive structural choke point. Or consider Fabrinet, a pure-play contract manufacturer. They assemble and test the finished optics for the industry giants, maintaining a pristine balance sheet along the way. This matrix compares the key players across scale, profitability, and strategic backing. The contrast is sharp. Coherent, Lumentum, and Fabrinet all offer diversified, profitable operations, often with direct NVIDIA capital, while AAOI remains subscale, highly concentrated, and dependent on equity dilution. AAOI clearly provides the highest leverage to this specific hardware cycle, but if you want a margin of safety built into your balance sheet, the larger peers offer a much stronger foundation. Deciding which of these companies belongs in your portfolio comes down to how much volatility you can actually tolerate. This chart maps the landscape: risk on the vertical axis, AI torque on the horizontal. AAOI sits top right, maximum trend exposure, but detached from fundamentals. Coherent sits middle right, providing high torque without existential risk, protected by existing profits and NVIDIA's backing. You give up the chance of a 20% overnight pop, but in exchange, you eliminate the risk of a single delayed order triggering a massive collapse. Keep in mind, every company building these pluggable transceivers faces a long-term technology risk. As network architectures evolve, the industry will eventually shift toward co-packaged optics, which could erode the current business models entirely. Optical interconnect hardware is undeniably the bottleneck of the modern AI data center, but making money here requires separating a great macro narrative from the harsh reality of a company's balance sheet.